Amid the stock market turbulence, Wall Street executives are heading to the White House today. This is almost what feels like a repeat of 2008 to discuss the response, this time, though, to the coronavirus breakout. Wilfred joins us. He is in Washington this morning. Wilf.
Good morning, Andrew. So top executives, as you said, from most of the nation's biggest banks will attend a meeting at the White House today, 3 p.m. Eastern Time, hosted by the president. In attendance will be the CEOs of Bank of America, Citi, Wells Fargo, Goldman Sachs, and U.S. Bancorp. For J.P. Morgan will be President and COO Gordon Smith, in place, of course, of the recovering Jamie Dimon. I understand that James Gorman of Morgan Stanley decided not to attend. The main focus of the meeting is small and medium-sized company lending, with the president keen to work with bank executives to encourage them to help struggling companies through any coronavirus-related short-term pressures. That, of course, is something banks have done before in the face of other challenges for their clients, for example, like hurricanes. We can also expect the topic of functioning of markets and levels of liquidity to be discussed. CEOs might be asked if there are any tweaks in regulation that could enhance liquidity in the short term. Now, bank stocks rebounded yesterday, but still down sharply year to date. And aside from policy discussion with the president today, investors will also be interested to hear directly from the bank CEOs for pretty much the first time during this virus-related crisis. Is the sell-off in their stocks overdone? We'll certainly try and pose that question today. Guys?
Well, thank you. I guess the big question is, in terms of getting that money out, we just talked to Marty Musi, looking at small businesses. His point was he'd like to see low or zero interest rate loans coming from the administration. That would be maybe more helpful than a payroll tax cut.
Yeah, so it's going to be pretty complicated to see how this could evolve and whether it's just a large group announcement or if there's hard policy behind it. The most common way most analysts I've spoken to think that this could be done is just getting the government to talk to the regulators and encourage them to lower the amount of capital that banks would have to hold against loans to, for example, small companies or, for example, loans to a specific sector like energy or airlines. And in doing that, that might give the banks a little more flexibility to take a bit more risk on in the short term. Of course, the offset to that is, will a bank still go ahead and make a loan to a company that they think is going to go bust or has a risk of going bust just simply because in the short term they hold less capital against it? So that's the most common way we could get there, but it's unclear how much difference that would make. You've got the extreme example we've seen in Italy, where the government has come in and backed the banks to temporarily remove all interest payments to all companies and on all mortgages to consumers. But nobody expects anything of that scale here.